You know, the thing about new investors or people that are new to investing is that they tend to somehow invest in a lot of speculative assets. And when you invest in speculative assets, the probability of you losing money becomes very, very high. For a lot of new investors or investors who don't really understand this thing known as the fundamentals of assets, investing becomes very, very risky. A lot of times when we jump into investing, people always ask, how much can you make? But investing is so much more than understanding how much you can make. Investing is also spending a lot of time understanding how much you can lose. Because every investment comes with risk. But that doesn't mean that once you understand how much you can lose, means you should not invest because there is a chance of losing money. Every investment comes with risk. It's always about this thing called risk management, which is what we're going to talk about today. Most people who don't understand risk management in investing will end up either stop investing because they have burnt their hands. There's this Chinese saying that you might have heard, which is 玩股票烧到手, right? I play with stocks and burn my hands. That is also because they don't understand risk management. And today we're going to talk about investment risk management. We're not going to talk about trading because trading and investing are both very different things. Risk management is what makes or breaks your long-term investment strategy. So today I want to introduce you a concept known as the investment risk pyramid. This pyramid has many different versions and different people have different opinions on what should go into each tier. So today I just want to introduce to you how I personally manage my risk when it comes to my own investment. This is my version of the investment risk pyramid. Let's go. Of course, the very first thing is to build foundations. Some people call them safety nets, but foundation is extremely important. Before you can even go into investing in the stock market or even ETFs, you need to have a very strong foundation for the rainy days. So some of the things that I categorize under foundation will be your CPF, which I think is extremely secured, would be things like your emergency funds. You know, what happens, where do you draw from when there's an emergency? Your safety net. Certain things that are, in my opinion, extremely secure, but still give you enough juice to beat inflation. These will be things like your money market funds, bonds, T-bills, and stuff like that. Now, you can include certain things like fixed deposit from a reputable bank into this category as well. But keep in mind that unlike the rest of the items that I just mentioned, fixed deposits are less liquid depending on how long your lock-in period is. But certain things like CPF, like your MediSave, if you really need it, you can actually draw on it. So this has the lowest risk, and if you live in a country like Singapore, the risk is almost zero. I wouldn't say zero, but almost zero. Most of the stuff is pretty liquid. So foundation, extremely important. Another thing that I think I would add into foundation would be your insurance, your basic health and life insurance, which is very important in case anything happens to you. That is a form of investing in security in your life, right? So that's also very important. Next level is what I call secure investments. In my own investment portfolio and journey, I don't really have a lot of this just yet because I see this as a way of preserving wealth, of building cash flow. As somebody who is turning 30 and somebody in our 30s, we still have quite a lot of runway. So I think to put a big chunk of money under wealth preservation and secure investments is a little bit of a waste because as of today, we have energy to go out and generate cash flow by working. So we don't need our assets to work that hard for us yet. But depending on which stage you are in life, this is the next level of the pyramid. If you are nearing retirement, your chunk here would look a lot fatter than mine. So, wealth preservation or secure assets would include things, in my opinion, such as dividend funds, REITs, or even real estate if your quantum is big enough, physical real estate. These things usually don't grow a lot in terms of the capital appreciation. However, they are relatively secure assets that provide good cash flow towards retirement, which I think is extremely important. Balance risk and balance liquidity. Next tier would be what I call stable growth. Now, this refers to assets that you buy that gives you relatively good returns, but at the same time will not make you a lot of wealth in a short amount of time. These assets, in my opinion, would be your ETFs, index funds, blue chip stocks, and stuff like that. I think if you buy the right things, would give you a solid 5 to 10% return per annum over the long term. It is not instantly life-changing, but if invested for an extended period of time, can grow very, very well. Even though most of these things like these funds, index funds, are relatively stable, we live in an extremely unpredictable world with an unpredictable economy. So an investment horizon of 5 to 10 years is still recommended in order for this to make sense. So yes, there is some risk in doing this, and liquidity is a bit lower because even though you can sell it anytime, if you just buy and sell as you wish, then that is called trading. You need to stay invested in the right assets for at least 5 to 10 years for the risk to be managed. Tier 2, which is your growth assets. For me personally, I have a pretty big chunk of my portfolio and assets in this category right now. So as I mentioned before, because I am turning 30, I'm in a stage where I have a little bit of earning power, I have energy and strength to build businesses, to grow my income. Therefore, I think I can take a little bit more risk to invest in more volatile things, because even if I were to lose some money here, my income earning ability is sort of the risk management strategy here. But if you are in your 40s or 50s, nearing retirement, or if you want to retire early, then you have to be very, very careful when buying assets in this category. In my opinion, assets in this category would be your individual stocks, especially tech stocks, certain blue chip cryptos like Bitcoin and Ethereum. I'm not referring to your super volatile meme coins, only Bitcoin and Ethereum in this category. And maybe certain other ETFs or funds that are very, very heavily invested in tech or more volatile things. There is more risk in this and of course lower liquidity. My opinion is that holding power here is also extremely important. If you do not have at least a 5 to 10 year horizon, then maybe reconsider your position in this asset category. Last but not least, which is the speculation asset, which is for some reason what a lot of youngsters and people who are new to investment like to invest in these days. For me personally, speculative assets would refer to things like your venture capitalism stuff, investing in small businesses, small tech companies, and stuff like startups and stuff like that. If you have the ability to do so, investing in certain businesses or alternative assets. There are a lot of companies out there in the world right now offering pretty good returns at like 10, 15, 20 or even 30% per annum, investing in speculative things. For example, tiny houses. For example, investing in wine and certain things like that, which I think could potentially make money. However, this category is extremely volatile, extremely risky, and extremely speculative. Unless you really, really understand what you're investing in, it is extremely dangerous. I'm not saying that these investments are not good. I personally put some money into speculative assets as well, but it's only a very small percentage of my portfolio, and I make sure to do my research before going into these speculative assets. Other assets that could be in this category, which I personally do not touch at all, would be things like penny stocks and meme stocks. This could make you 3x, 5x, 20x, 30x in a matter of months. But to me, these are extremely, extremely speculative. I do not understand them, therefore, and I have no interest to research them, therefore I do not invest in them. So there you have it. This is my 5 tiers of the investment risk pyramid. It would look different. So the chunk of money you put in each risk would look different in different stages of your life. So as of today, I have quite a good portion in foundation, but majority of my assets actually lies in tier 2, which is my volatile growth. As I grow older, as I work towards retirement, and as my earning power decreases because of lack of energy and stuff like that, I would slowly readjust my asset allocation to have more at the bottom and less at the top, because it is about risk management. So if you have all your assets in speculative, then your risk management is basically close to zero, because you're like 100% risk all the time. So decide which season and which stage your life is in and allocate the assets accordingly based on where you are, your earning power, and how much you already have in your portfolio. Hope this helps you understand investment risk management, but keep in mind that this pyramid is something that I customize to myself and where I think each asset should belong in each category. All of us should look different. Please do your own research and understand each asset before you go and execute your risk management strategy. Nonetheless, risk management is extremely important. If you like businesses, if you like personal finance and investments, give me a like, subscribe, and follow, and I will see you in the next video. Peace!